China's steel industry is currently in a bit of a holding pattern. Steel demand can only be described as stable but uneven, as demand for your different steel products diverges. For example, your construction-linked demand has weakened sharply, and that's mainly because of the property sector. The property sector remains the biggest drag for your steel demand, while public infrastructure, which is your trains, large spending infrastructure by government, has held up for most of the year, but kind of lost momentum in the third quarter. As a result, we've seen a consumption of your long products, which are mostly driven by construction demand fall. In contrast, you've got your flat steel demand, which is mostly used in manufacturing. That's held up a lot better. If we look at the export market, where there is also quite a bit of demand, your prices are actually higher than a year ago. And this is supported, like I said, by your export orders and manufacturing. For example, if you look at your vehicle sales, your rise in vehicle output into your emerging markets has provided a bit of an offset to weakness in the construction sector. On the supply side, steel output has somewhat eased modestly in recent months. It's actually been quite strong, and that's mainly due to tighter profitability in your rebar and other construction-related steel products, and that's just weak demand overall. If we actually look at the steel mills themselves, they're running themselves hard enough to stay efficient and mostly profitable at the margin, and they're also trying to balance maximum utilization. Utilizations year to date are still well above 90%, and that was in September. So the government has been trying to discourage this, and they call this involution. So they're running a campaign called an anti-involution campaign, which is can only be described as unnecessary competitive behavior, like a race to the bottom in pricing, regardless of profitability. It's to grab market share. So these measures have come across as a bit more light touch and soft in practice, but it seems like policy tone more recently after the fourth plenum for the 15th five-year plan seems more pro-growth, which seems a bit more supportive in the short term, but in the end we still think fiscal space is limited. Like I said, when I mention policy, I'm talking about urban renewal plans, manufacturing upgrades. This will all lend support to steel at the margin, but long term we still don't think we'll see the same steel demand cycle as we've seen in the last decade that was supported by your real estate sector. Overall, the balance between your export strength and this domestic fragility is likely to persist into next year. So what does this mean for commodities? We still see iron ore prices reaching $85 in the long term, and this is mostly supported by new supply like Simandou coming online, as well as a weaker demand in your domestic, in your Chinese market, which is largely construction. So we think coking coal will remain relatively tight going into 2026, keeping prices firm, thus squeezing margins for your steel mills. In our entire coverage universe, we prefer your base metals in the short to medium term, and that's copper in particular. We see fundamental support for pricing due to operational disruptions that we've seen in the past year at some of your major operations, and we think that's going to translate into a deficit in the coming year.